Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me back. There is definitely a lot to cover today.
There really is. So today is Thursday, July 9th, 2026. And if you look around at the broader economy right now under the current Trump administration, the overall mood in the business world is heavily focused on, you know, growth, deregulation, and just pushing boundaries.
Oh, absolutely. The stock market is roaring right now, and it's driven almost entirely by this massive artificial intelligence boom.
Right, exactly. But then, according to recent analysis, something kind of weird happened on Tuesday. Amazon went to Wall Street to borrow $25 billion. And they are arguably the most profitable tech giant on earth, right? They are practically swimming in cash.
Yeah, they really are.
Yet the bond market barely showed up. So today we are doing a deep dive into why the financial world is, well, quietly starting to ask for the receipts on all this AI spending.
Yeah, it's a fascinating situation. The contrast between the stock market's absolute euphoria and the bond market's sudden hesitation, it's really the most critical story in finance right now.
It really feels like a massive structural shift in how big tech operates. We're going to uncover why this acts as a quiet warning signal and, more importantly, explain what this means for you, the everyday learner just trying to make sense of this whole AI boom.
Right, because watching the bond market hesitate on an Amazon issuance it's like watching a casino refuse a line of credit to the house.
Wow. Yeah, that's a great way to put it.
It signals an underlying mechanical issue in the market's plumbing that we really need to look at closely.
So let's get right into the facts based on the data. On Tuesday, July 7th, 2026, Amazon issued $25 billion in corporate bonds. They spread this out across 8 different tranches, with maturities ranging from 2029 all the way out to 2066.
That is a long time horizon.
Right, and they brought in the heavy hitters to fund this AI infrastructure. Joint lead managers were Barclays, Goldman Sachs, JP Morgan, and Morgan Stanley.
The biggest names on Wall Street.
Exactly. Okay, let's unpack this, because here's the surprising detail. While the sale was technically successful, bringing in about $41 billion in orders, it was only oversubscribed by about 1.6 times.
Which in the bond world is noticeably weak.
Yeah. For context, the 2026 average for U.S. investment-grade corporate bonds is usually an oversubscription of about 4 times.
Exactly. A 1.6 for Amazon is basically a cold shoulder from investors.
But wait, I have to play devil's advocate here. Amazon's essentially a money-printing machine. This is like the straight-A student with a trust fund asking for a small loan. Why wouldn't investors be lining up around the block to lend to them?
What's fascinating here is that this lack of overwhelming demand, it isn't actually about Amazon's credit.
It's not.
No, not at all. Nobody on Wall Street believes Amazon is going to default on a bond in 2029 or, even 2066. Amazon is still a cash-generating powerhouse.
So what's the actual problem then?
The real issue is AI debt oversupply. The market it's simply getting full.
Interesting. Getting full of tech debt.
Right. The institutional buyers who absorb these massive issuances, like pension funds or major life insurance companies, they are hitting their absolute limits.
Oh, I see. So if Amazon isn't the problem, the industry itself must be changing. Which brings us to this massive transformation of how tech companies even operate.
Precisely. If you look at the reports, the numbers are staggering. AI-related corporate bonds have been weakening across the board because big tech companies, Microsoft, Alphabet, Meta, Oracle, NVIDIA, they now have over $460 billion in outstanding debt.
Wait, $460 billion?
Yes, and nearly $100 billion of that was issued in 2026 alone. Big tech now makes up a record 8% of the entire U.S. corporate bond market.
That is wild. 8% of the whole market. But why do they suddenly need all this cash? Big tech used to be so capital efficient. Right.
Exactly. For the last 20 years, they were all about high-margin software platforms, cloud services. Once you write the code, selling it to 1 million more people costs almost nothing.
Right. Pure profit.
But now, to win at AI, they're acting like capital-intensive utility companies.
Oh, wow. So they're building factories instead of apps.
Basically, yeah. They need massive data centers, hundreds of acres of land, heavy-duty cooling systems, millions of GPUs, and these long-term power contracts just to keep the lights on.
So it's like a famous local bakery that used to just sell digital recipe books with huge profit margins. But now they've suddenly decided to build a massive, automated, $1 million commercial kitchen. It's a completely different, much heavier business model.
That is a perfect analogy. And because of that heavy business model, investors are facing what we call an issuer concentration limit.
Meaning they can't put all their eggs in one basket.
Right. They can only hold so much debt from one sector before it becomes too risky for their portfolio, no matter how good the companies are.
Okay, that makes sense. But here's where it gets really interesting. If AI is such a sure bet for the future, why is the bond market acting so cautious when the stock market seems thrilled? I mean, shouldn't lenders be throwing cheap money at these companies to get a piece of the action?
Well, that highlights the fundamental difference between a stock investor and a bond investor. Let's break it down. Stock investors, they're like the co-owners of the business.
Okay, so they get to share in the wins.
Exactly. They buy the option of future growth. If AI is a massive success and creates trillions in value, the stock price skyrockets. They get all that upside.
Right, the sky is the limit for a stock owner.
But bond investors are basically the bank. They do not get a share of those massive future profits.
Oh, right, because their return is capped.
Precisely. They only get their fixed interest payments and their original money back. That's it. But if the AI investment fails, or the company overspends and goes bankrupt, the bondholders risk losing their money.
So they get all the downside risk and absolutely zero extra upside.
You got it. And because of that, bondholders are getting nervous about this heavy industry shift. Look at the data. Amazon's 2036 bond, the one paying 5.8%, its spread widened from 0.63% to 0.7%.
And just to clarify for everyone, the spread widening means what exactly?
It means the bond market is demanding higher yields, more reward, for taking on this massive new debt. And it's not just Amazon. Meta's 2036 bond spread widened as well.
Wow. So capital is literally getting more expensive for them. Which begs the question, if the bond market is charging them more, why don't these tech giants just slow down their AI spending?
Well, the spending spree is just mind-blowing.
Yeah.
In the second quarter of 2026, Google, Amazon, Microsoft, and Meta pushed their AI capital expenditures to an estimated $168 billion.
$168 billion in one quarter.
Yeah, that is a 74% increase from the previous year.
That is just, I mean, it's hard to even wrap your head around that much cash. Why are they doing this to themselves?
If we connect this to the bigger picture, it's because AI is largely viewed as a winner-takes-all, or at least a few winners market.
So there's no silver medal in AI.
Basically, no. If a company stops spending just to save some cash, they will instantly fall behind in model performance, cloud market share, and their developer ecosystems.
I see. So it's a high-stakes poker game. The buy-in keeps getting higher. And if you fold now to save your chips, you basically forfeit any chance of winning the massive jackpot on the table.
Exactly. You either pay to play or you become irrelevant. But the real message here isn't that the bond market wants them to stop building AI.
It's not.
No. The bond market is just saying, look, if you want to keep playing this game with our money, you need to prove exactly how and when this new infrastructure is going to generate actual cash flow.
They want to see the receipts.
Right. They want a clear path to profitability, not just promises of future tech revolutions.
So what does this all mean for you, the listener? How should you apply this knowledge to your own understanding of the economy when you're watching the news or looking at your own portfolio?
The biggest takeaway is to look at the balance sheet. For years, the tech rally was all about the income statement, revenue growth, user growth, that sort of thing.
But now that's shifting.
Completely. The AI rally is moving to the balance sheet. It's all about managing debt and depreciation. As an investor or observer, you should be looking at the capital recovery period.
The capital recovery period, meaning how fast they can pay off those million-dollar GPU clusters before they become obsolete.
Exactly. The long-term winner won't just be the company that spends the most money. It's going to be the one that efficiently turns AI usage into actual revenue while carefully managing their massive debt.
So efficiency beats just throwing cash at the wall.
Always. And there's another angle here, too. The supply chain advantage.
Oh, right, because someone has to build all this stuff.
Exactly. This massive $168 billion spending spree. It's great news for the companies supplying the infrastructure, the semiconductor manufacturers, the power infrastructure companies, the data center builders.
It's the classic gold rush rule, right? Don't bet on the gold miners, bet on the guy selling the shovels.
Precisely. Even if the tech giants get squeezed by the bond market, the shovel sellers are getting paid up front.
That makes total sense. So to summarize all of this, Amazon's bond sale wasn't a failure, but it was definitely the opening bell for a new era. AI is no longer just a technology race, it is a capital funding race.
It absolutely is. And this raises an important question for everyone to think about.
Okay, let's hear it.
What happens in a few years if these massive AI data centers are built? The debt bills finally come due, but the everyday consumer demand for AI just isn't high enough to pay for it. Who absorbs that massive cost?
Wow. Yeah, if people decide they don't want to pay $50 a month for an AI subscription, that is a terrifying thought for Wall Street. We'll definitely have to keep our eyes on that. Thank you so much for breaking this all down today. And for you listening, don't forget to subscribe and hit that like button.